Welcome to Windfall Edutech Intermediate Module. Chapter 5 FII and their role in Indian equity market. FII. How does SEBI regulate FII financial instruments? For FII Participatory Notes (PN), FII's influence on equity market. FII's investments. FII, foreign institutional investor. FII is an investor, mostly of the form of an institution or entity, who invests money in the financial markets of a country different from the one wherein the institution or entity was originally incorporated. FII means an entity established or incorporated outside India which proposes to make investment in India. International institutional investors must register with the Securities and Exchange Board of India to participate in the market. One of the major market regulations pertaining to FIIs involves placing limits on FII ownership in Indian companies. Entities or funds that are eligible to get registered as FII include pension funds, mutual funds, insurance companies, reinsurance companies, investment trusts, banks, international or multilateral organization or an agency thereof, or a foreign government agency or a foreign central bank, university funds, endowments serving broader social objectives, foundations serving broader social objectives, and charitable trusts, charitable societies. The following entities proposing to invest on behalf of broad-based funds are also eligible to be registered as FIIs. Asset management companies, investment manager, advisor, institutional portfolio managers, trustees. How does SEBI regulate FII? FIIs who issue, renew, cancel, redeem P-notes, are required to report on a monthly basis. The report should reach the SEBI by the 7th day of the following month. The FII merely investing, subscribing in, to the participatory notes, or any such type of instruments, securities, with underlying Indian market securities are required to report on quarterly basis, January to March, April to June, July to Sep and October to December. FIIs who do not issue PNs but have trades, holds Indian securities during the reporting quarter, January to March, April to June, July to Sep and October to December, require to submit nil undertaking on a quarterly basis. FIIs who do not issue PNs and do not have trades, holdings in Indian securities during the reporting quarter, January to March, April to June, July to Sep and October to December, no reports required for that reporting quarter. SEBI parameters for FII applicants. Eligibility. Applicants' track record, professional competence, financial soundness, experience, general reputation of fairness and integrity. The applicant should have been in existence for at least 1 year. Whether the applicant is registered with and regulated by an appropriate foreign regulatory authority in the same capacity in which the application is filed with SEBI. Whether the applicant is a fit and proper person. Financial instruments available for FII. Securities in primary and secondary markets including shares, debentures and warrants of companies, unlisted, listed or to be listed on a recognized stock exchange in India. Units of mutual funds. Dated government securities. Derivatives traded on a recognized stock exchange. Commercial papers. Participatory notes. Participatory notes are instruments used by foreign investors that are not registered with the SEBI, Securities and Exchange Board of India, to invest in Indian stock markets. For example, Indian-based brokerages buy India-based securities and then issue participatory notes to foreign investors. Any dividends or capital gains collected from the underlying securities go back to the investors. That is why they are also called offshore derivative instruments. Trading through participatory notes is easy because participatory notes are like contract notes transferable by endorsement and delivery. Secondly, some of the entities route their investment through participatory notes to take advantage of the tax laws of certain preferred countries. Thirdly, participatory notes are popular because they provide a high degree of anonymity, which enables large hedge funds to carry out their operations without disclosing their identity. Since international access to the Indian capital market is limited to FIIs, the market has found a way to circumvent this by creating the device called participatory notes, which are said to account for half the amount that stands to the credit of FIIs. Investing through P-notes is very simple and hence very popular. Hedge funds, which invest through participatory notes, borrow money cheaply from Western markets and invest these funds into stocks in emerging markets. This gives them double benefit, a chance to make a killing in a stock market where stocks are on the rise, and a chance to make the most of the rising value of the local currency. Why is SEBI not happy with PNs? Indian regulators are not very happy about participatory notes because they have no way to know who owns the underlying securities. Regulators fear that hedge funds acting through participatory notes will cause economic volatility in India's exchanges. Hedge funds were largely blamed for the sudden sharp falls in indices. Unlike FIIs, hedge funds are not directly registered with SEBI, but they can operate through sub-accounts with FIIs. These funds are also said to operate through the issuance of participatory notes. Influence of FII on Indian stock market. Market pundits often attribute the rally of stock market and fall of stock market to the flow of funds by FIIs. We often hear the terms, FIIs fuel the market run. Major impacts are, they increased depth and breadth of the market, they played major role in expanding securities business, their policy on focusing on fundamentals of the shares had caused efficient pricing of shares. These impacts made the Indian stock market more attractive to FIIs and also domestic investors, which involves the other major player MF mutual funds. The impact of FIIs is so high that whenever FIIs tend to withdraw the money from market, the domestic investors become fearful and they also withdraw from market. FII investments. A major contributor to the dramatic stock market comeback in 2009. The FII investment of 80,500 crore rupees in 2009 is the highest ever inflow into the country in rupee terms in a single year and comes a year after they pulled out over 50,000 crore rupees. Although FII inflows were high in 2009, but no of new FIIs were very limited this year compared to the previous years. This was mainly due to high-profile collapse of Lehman Brothers and others, which deterred the new entities from entering the Indian market. FIIs have made merry in 2009. Major reasons for resurgence of interest by foreign investors were low interest rate regime in US, UK and also ease of restrictions on P-notes. However, till 2007, FIIs were mostly using P-notes used by foreign funds in India to trade in local shares, but off late, more and more FIIs prefer to park their funds through sub-account route. This is mainly due to the uncertainty among FIIs. Till March 9, stock markets were going southwards, as FIIs were selling all the way. It's only after March 9 that stock markets picked up, and the reason for that was fairly simple. FIIs started buying April onwards. From this, we can clearly make out that surge in the Indian stock markets is heavily influenced by FII investments. Indian stock markets more often than not dance to the tunes of FIIs. FIIs inject much needed liquidity in stock markets, which automatically uplifts people's sentiments. Thank you. Revise and get ready for the next